Hi, in this video, I will guide you through a comprehensive understanding of perpetual contracts. By the end, you will have a complete grasp of perpetual contracts, their mechanisms, and the key points to be aware of. Since perpetual contracts in the cryptocurrency market require precise handling, I will break down every detail for you. So here is the outline of what this video covers. So the first one is the origins of perpetual contracts, and then funding rates, understanding shorting, leverage, margin, precision, liquidations, and also liquidation price and market price. Openings, holding, closing, reducing and increasing position, limit orders and market orders, limit order makers and market order takers, calculation of commissions, and take profit stop loss, isolated margin, cross margins, and the last one will be demonstration of actual order opening. To fully understand perpetual contracts, you first need to understand future contracts. Future contracts, often called futures, are common in commodities like soybeans, copper, silver, and nickels. The future in futures contracts represents a future period such as next week, this quarter, or the following quarters. The goods in contracts refer to the exchange of money for goods, commonly known as deliveries. A contract is essentially an agreement between buyers and seller to complete a transaction based on the agreed times, price, and quantity of goods. So futures contracts originated from agricultural products like wheat. Farmers and buyers agreed on the price for wheat a year in advance. Regardless of whether wheat price rose or falls the following year, the contract price have to be honored. The farmer needing to sell their produce will open the sell orders or short positions, while the buyers intending to purchase the goods will open the buy orders or long positions. If there was a bountiful wheat harvest in the following years, price will drop, and the farmer's short position will be profitable. Conversely, if there was a poor harvest, price will rise, and the buyer's long position will gain. Essentially, when farmers and buyers enter into a contract, they are betting on the future price of wheat. Farmers who produce wheat annually and need to sell with benefits from signing a sell contract in advance to hedge against the rise or falling price. If wheat price falls, the profits from the short positions compensates for the loss in the wheat market price. This strategy is known as hedging, a common term in cryptocurrencies. In future videos, I will also explain how to execute hedging strategies in the cryptocurrency market, and the contract itself can be bought and sold. For instance, the contract between farmer A and buyer A can be sold to farmer B, making it the contract between farmer B and buyer A. After farmer A transfers the contract, farmer B will settle the profits or loss with farmer A based on the price difference between the original contract and the price at which it was transferred. This process is known as opening a position or building a position for farmer B, while farmer A closes positions, realizing a profit or loss. And as the market evolved, farmers, great traders, and professional speculators began participating in wheat contracts trading, increasing market activity. However, only the real farmers and grain traders will hold the contracts until the expiration date for physical delivery, and speculators typically close their positions before the contract expires. From the trading volume perspective, the volume of trades by speculators far exceeds that of those engaging in actual physical delivery. Due to the high trading volume of speculators, perpetual contracts were developed. Perpetual contracts has no expiration date, eliminating the need for physical settlements of goods and saving speculators from frequently adjusting their positions. Thus, the sole purpose of perpetual contracts is to predict and trade based on the asset price. Another advantage of perpetual contracts is that they eliminate the need to dividing the trading market into different time frames, such as weekly, bi-weekly, or quarterly contracts. This means all the liquidities can be concentrated in a single perpetual market, resulting in excellent liquidity for perpetual contracts. This high liquidity makes it particularly easy for large funds to enter and exit the market, making the perpetual contracts the most liquid volumes in cryptocurrency. Next, let's talk about the funding rates. First, look at the chart. The red line represents the spot price, while the black line represents the future contract price. You can see that at each expiration date, the black line quickly converges with the red lines. This happens because the settlements of future contracts on the expiration dates anchors the future price to the spot price through physical deliveries, preventing the futures price from deviating from the spot price. And the concept of the funding rate was introduced to prevent the price of perpetual contracts from deviating from the spot price. The funding rate is not a fixed exchange charge, but a payment between long and short positions within the perpetual contract markets. As a result, the funding rate can be either positive or positive. If the price of a perpetual contract is higher than the spot price, the funding rate is positive, meaning that long position holders must pay short position holders based on their position size. Conversely, if the price of a perpetual contract is lower than the spot price, the funding rate is negative, and the short position holders must pay long position holders based on their position size. Most exchanges settle the funding rates at 12 p.m., 4 p.m., and 8 a.m. This means that if you close your position before the funding rate settlement time, you won't have to pay the funding rates to the upsizing side. Binance, the world's largest exchange, typically have a funding rate of minus 0.03% and 0.03% per settlement period. The funding rate is calculated using the formulas. Position size multiplied by the funding rate. For example, if I use 10,000 USDT to open a position with 5 times leverage, my position size is 10,000 USDT multiplied by 5, which equals 15,000 USDT. If the funding rate is minus 0.0114% as shown in the chart, short positions holders need to pay long positions holders. So the funding fees I will receive for that period is 0.0114% multiplied by 15,000 USDT, which equals 5.7 USDT. Among all exchanges, Binance has the highest trading volumes of perpetual contracts. You can find a link to register a Binance account by clicking the expand buttons in the description of this video. Registering using this link will give you a permanent 20% discount on trading fees. When you open a futures account, you can also use the referral code displayed on the screen to enjoy a 10% discount on fees during the first month of futures trading. The funding rate has two main applications. The first is funding rate arbitrage. There is an arbitrage opportunity since the funding rate can be either positive or negative. A common strategy is to buy the spot assets and simultaneously open the short positions in the coin margins perpetual contracts for that assets. Because the funding rates for major cryptocurrencies is usually positive, you can earn the profits from the funding rates. As shown in the chart, over the past 14 days, the funding rates for the Bitcoin's USDT perpetual contracts on Binance has been positive most of the time. Therefore, you can take advantage of funding rates arbitrage by opening the one-time short positions in the coin margin contracts. The second applications involve identifying extreme values in the funding rates to fund trading opportunities in the market. You can access the real-time funding rate page on the detailed information page for Binance futures. By sorting the funding rates, you can identify contracts with extremely high or low funding rates. I will also provide this URL in the video description so you can check it out. An extremely negative funding rates indicates that the contract price is significantly lower than the spot price, suggesting that many retail investors are shorting the assets. In such a scenario, a sudden price surge could trigger stop losses or liquidations for these short positions, which could be an attractive opportunity for market makers. If you want to profit from this data, you should look for contracts with extremely negative funding rates during the bull market, as success rate will be higher. Now, let's talk about shorting. Understanding shorting can be quite challenging for beginners, so I will explain the concept through an example. Let's say you are not optimistic about the Solana coins and want to profit from shorting it. Here is what you need to do. The first step is to collateralize your USDT to qualify for borrowing the coins. The USDT you collateralized serve as your margins. The second step is to borrow SOLs from the exchange. And the crucial third step is to immediately sell the borrowed SOLs in the exchange for USDT. And if SOLs price drops afterwards, you can then buy SOLs at a lower price with the USDT you receive. Once you repurchase SOLs, you can return it to the exchange, completing the profit-making process. When borrowing from the exchange, you return exactly what you borrowed. If you borrow SOLs, you simply need to return the same amount regardless of its price. The diagram below illustrates a market decline. So you will execute step 3, selling at one point, and step 4, buying at another point. Step 3 corresponds to selling, and step 4 corresponds to buying. In the entire process, step 1, 2, and 5 are essentially skipped, simplifying it to just selling and buying to complete the contract process. For the sake of simplicity, we omit step 1, 2, and 5, but in reality, the process follows a sequence of step 1, 2, 3, 4, and 5. So the actual process is to borrow the coin first, sell it at a higher price, and buy it back at a lower price, and return the borrowed coins. Typically, we think of buying lows and selling highs where you need to own the assets before you can sell it. However, with perpetual contract derivative in the crypto world, you can sell an asset by borrowing it from the exchange even you don't own it. Four important concepts to understand are leverage, margins, position size, and liquidations. Leverage is essentially a multiplier on your margins. For instance, if you use 5 times leverage with a margin of 10 USDT to shorts, you can control 50 USDT worth of the assets, meaning your maximum position size is 50 USDT. What does holding a 50 USDT position mean? This means you need to bear the profits or loss resulting from the asset's price movement worth 50 USDT, which is the concept of position size. In the chart, you can see that the current position is 90 XRP. If I switch the display units, I can also show the position size in USDT. The underlying logic is the same, only the display format differs. Next, let's calculate how a leverage contract can result in profits or losses. First, let's say I open a short position with a 10 USDT margins and use a 5 times leverage. If the price of XRP drops by 0.1 USDT per coin and I hold 100 XRP, my profits will be 100 XRP multiplied by the 0.1 USDT gained per coin, resulting in a total profit of 10 USDT. Conversely, if the price of XRP increases, my short positions will result in a loss. If the price raises by 0.1 USDT per coin and I hold 100 XRP, the total loss will be 10 USDT. At this point, you will notice that my 10 USDT margins can no longer cover the loss, and the loss equals my margin equal to your liquidations. So here is the liquidation formulas. If the leverage multiplied by the offset price movement, the movement causing the loss reaches 100%, you will be liquidated. In this example, with 5 times leverage, a price increases of 20% in the opposite directions will result in liquidations. If we increase the leverage, say in 50 times, then even a small price increase of 2% will lead to liquidations. So for beginners, it is important not to use excessively high leverage. Generally, 10 times leverage is more than enough. High leverage often lead to liquidation and existing in the market. Now let's discuss the liquidation price and the mark price. On every position page, you will see a liquidation price. This is an estimated calculating advance price at which you will be liquidated. The closer your position gets to this price, the higher the liquidation rate. So what are the entry price and the mark price? The entry price is straightforward. It is the price at which you opened your position in a single market like Binance. And the mark price, however, is a weighted average price across multiple markets and is often used for closing positions or setting take profits and stop loss orders. The mark price exists to prevent market manipulations by large players. Sometimes these market makers engage in price manipulations. Binance doesn't rely solely on its market price for liquidations. Instead, it used the weighted average price from multiple exchanges known as the mark price. The mark price is derived from the price on a variety of exchanges. As you can see, there are many. For a market maker to manipulate the price and cause retail traders to be liquidated, they will need to influence the price across all these exchanges simultaneously, making such manipulations much more difficult and reducing the chance of market manipulation. Next, let's discuss the various types of position operations. So first, what is opening a position? Opening a position simply meaning place an order. You can either go short or go long. Going short is essentially a sell action, while going long is a buy action. This concept is explained in more detail. What is holding a position? Holding a position meaning maintaining your order in the market. The market's fluctuations will affect your potential profits or losses, known as unrealized profit and losses. And what is closing a position? Closing a position involves shorting down your orders, converting unrealized profits or losses into realized profits or losses, thereby financialize your gains or losses and assisting the trade. So for here, you can choose not to close 100% of the positions on the closing page. Instead, you can close 25%, 50%, or any other proportion. This partial closing is known as reducing a position. It allows you to lock in some profits while leaving the remaining portion of your positions open to continue benefiting from market movements. And what is adding to your positions? Adding to your position is even simpler. It means opening additional orders in the same directions, often using the profits you've already made to increase your positions. This is known as compounding profits by adding to your positions. I will explain this further in upcoming videos. And next, limit orders versus market orders. A limit orders means setting your own price for an order and waiting for it to be filled. The left side of the screen often displays a list of bytes known as the order book. The middle price is the latest transaction price. Below that, you will see buy orders from those wanting to purchase at a lower price, while above it, you will see sales orders from those looking to sell at a higher price. If two people place orders at the same price but with different quantities, they will become buys and displayed in the order book. This is why you will see different levels of buy and sales orders labeled as B1, B2, which is buyer 1, buyer 2, and S1, S2, seller 1, seller 2, and so on. All buy and sales orders collectively form the order book. Then what is a market order? A market orders involve directly buying or selling at the current available price in the order book. When you place a market orders, it removes an existing orders from the book, known as consuming the order, and usually limit orders are considered makers because they create liquidity in the market, leading to a lower transaction fees. On the other hand, market orders are takers because they reduce the liquidity in the order book, resulting in higher transaction fees. And then let's move on to how transaction fees are calculated. Binance charge fees in both directions. The maker fees is 0.02% and the taker fees is 0.04%. For example, if you use 10 USDT as a margin with 5 times leverage, your position size will be 50 USDT. If you open the position using a limit order, the fees will be 50 USDT multiplied by the maker fees of 0.02%, resulting in a fees of 0.01 USDT. And if you close the position using a market orders, the taker fees will be 50 USDT multiplied by 0.04%, resulting in a fees of 0.02 USDT. To save on fees, you can register for a Binance account using the link in this video's descriptions. And then understanding take profits and stop loss. To grasp take profits and stop loss, you need to understand two key concepts: trigger price and order price. The core rule is, if the price reaches X, place the orders at Y. For example, let's say you have an XRP short position with an entry price of 0.5 USDT. Now you want to sell common so that your position is closed if the price drops equals to 0.4 USDT. Here the trigger price is 0.4. The trigger price is the condition that once met, the order will be placed into the market at specified price, the order price or the commission price. Since this is the short position, your take profits order will actually be a buy order to close your short. To increase the likelihood of executions, order price should be slightly higher than the trigger price, such as 0.401. However, during volatile market conditions, there's still a chance that the take profit orders may not execute. To ensure it does, you can change the order type from a limit order to a market order after the trigger price is hit. This way, your order will match the opposite orders in the market immediately, ensuring that the position is closed and the profit is taken. Therefore, it is often preferred to set take profits and stop losses using market orders rather than limit orders. Last is the concept of isolated margins versus cross margins. Isolated margins allows you to allocate a specific amount of funds to a position. So if that position gets liquidated, only the allocated funds are affected and the rest of your accounts remain safe. Cross margin, on the other hand, uses all the available funds in your margin accounts to maintain the positions. Even if you only allocate 1/3 of your funds to open the positions, the remaining 2/3 are also at risk if the position goes against you. For example, ancient Chinese ship were designed with watertight compartments, so that if one compartment was breached, it wouldn't flood the entire ship, making them safer. Similarly, it is generally safer to use isolated margins when opening positions. And then finally, using the web interface, I will demonstrate how to operate Binance Perpetual contracts in real time. You can find a link to Binance in the description of this video. Click sign up, and then click sign up with email or phones. Enter your email, and then on the referral ID sessions, manually enter my referral code WLUA5XI6 to get a permanent 20% discount on fees. So when you enter Binance interface, hold your mouse over future sessions and find USD SM future buttons, click on it. So here for those opening a future account for the first time using the code WLUA5XI6, we fill out the referral codes to enjoy the fee discounts during your first month of future trading. Once you've accessed the platform, the first step is to transfer USDT to your future account. You can do this by clicking the double arrow icons on the right side to transfer some USDT from either account into your future account. Click on it. So for here, USD SM futures, meaning opening and settling trades using USDT, making calculations straightforward and convenient. You can transfer USDTs from your spot account or funding account. And for here, I will transfer all my USDT, click max and click convert. And then you will find a different contract trading pair you can select on the left. It is important to focus on pairs with high trading volumes. You can sort by volume in descending order by clicking the volume headings, which is here. Click on it. Usually Bitcoin and Ethereum Perpetual contracts have the highest volumes, so let's trade the Bitcoin USDT Perpetual contracts. Click on it. And here you can see the funding rate, which is currently negative. And before shorting, change the margin mode from course to isolated for added security. Click convert. And the leverage is short as 20 times by default. Let's lower it to 10 times and click convert. And below it, you can then choose between place a limit orders or market orders. I will choose to play a market orders. And then I will set the quantity to the 50% of my USDT and select open short to go short. Click convert. And then scrolling down, you will see I now hold 10 times short positions in Bitcoin. Detailed data shows the unrealized profits and loss, P&L, and the returns on investments are out. There are options to close the position with one click. You can close at the market current price or close at limit price. And look further, there even reverse the order. The reverse function instantly allows you to switch your short positions to a long one. Sliding the screen to the left, you will find the take profits and stop loss options. Click the arrow button to set it up. First, let's set the take profits by choosing the market price. So we can see that the current price is around 59,500 USDT. And since this is the short positions, the lower the price drops, the more profits you made. Then you can set the trigger price at 55,000 USDT. So for here, we can see that when Bitcoin drops to 55,000 USDT, your expected profit is 7.42%. And then you can also take a partial profit such as 60%. Here you can see that your estimated profit will be 8.81 USDT, and then click add split targets. And then convert, click convert again. For here, your take profit order is set. Next, set out the stop loss by clicking the plus side. And again, choosing the market price, set the order price or stop price at 61,000 USDT. And then adjust the quantity to full. Click add split target. And then click convert, click convert again. You can check the details of your take profit and stop loss settings by clicking details, which is here. Click on it. And at this point, we can see that my position is showing a small loss. If I decide not to hold the positions, I can close it at the market price and my Bitcoin position will be fully liquidated. So I will just close on here, click convert. You can review the trade history by clicking trade history here, and from here is showing the transaction details and fees. So Binance charge fees based on your position size. That's all for this video. If you have any questions, feel free to leave your comments. Thank you and see you in the next one.